Hi, welcome to MediSafety's podcast, where today I'm going to talk about buying or selling a business. It is probably one of the more complicated transactions that any real estate agent or broker is going to be dealing with. Primarily, the reason for that is that usually there are no accurate information, or information that may be provided to you is been exaggerated or fabricated in order to make the sale. Now, obviously, that doesn't work in purchasing or selling a franchise or a well-known brand. Now, keep in mind, I don't get a prize from them for saying that, but it is a fact. The reason behind that is when you have a franchise, any of the big names, every single dollar is accounted for. And once somebody would proceed forward to purchase a franchise, you can get the information going back years as to what the sales are, what the expenses are, how many employees they have, etc., etc. But when you're dealing with the smaller operations, now this doesn't mean that smaller operations are not good. Yes, they are. But you got to make sure, as a buyer, you got to make sure that what you're buying is legitimate, is properly due diligence are done on it. And you, if you're a seller, you got to make sure that what you're providing the potential buyer is accurate and is reliable, because you know that buyer, most cases, is represented by an agent like myself, that they're going to look into these things and they're going to investigate it and make sure that what you're providing them is accurate. Now, there is a golden rule that I always share with my business colleagues, or people that are coming to me and asking if this is a good business. You know, we've done this, we've done that, and we're going to purchase it. I always say, if the business is good, they're not going to sell it. Like, if they're selling, in most cases, is because they're not making money on it. Now, one would argue that with me and say, oh, I bought this pizza place or coffee shop or a sign making company, and we're making money. You see, whoever buys these places, to start with, they're business minded people. That means they understand how the formula works. So if a business is making money, but if they claim that they're tired, they've been at it for 20 years, or God forbid there's a sickness in the family, or whatever the reason may be, they can easily replace themselves by hiring someone to do their job, and you still end up with the cash flow coming to you. Now, you may ask, say, okay, if the business is not doing good, why do people still go after them and to try to purchase them? The reason behind that is they're either new in Canada and they're looking for a business to get established here. In some cases, purchasing a business, it would help them to get their Canadian status easier. And they have a dream. They have a dream. They think that for whatever reason that business has not performed as well as it should be, they have an idea that they can turn it around and basically turn it into a very successful operation, or eventually they're even thinking about converting it into a franchise. So, to sum it all up, there is an unwritten rule that, and I'm going to cover both from a seller's point of view or the buyer's point of view. If you're a seller and you're trying to determine as how much you should sell that business for, this is how it works. Whatever the price you're asking, the buyer should be able to recover that initial money within the first 3 years. That's how you price your business. So if you're asking, let's say, $300,000 for your business, the buyer should be able to get that $300,000 back in the first 3 years, assuming that the buyer is going to set aside a salary for himself because he's doing the job there anyways. And for you, the buyers, that's how it works. This is the formula where you should be able to recover your money within the first 3 years. Now, usually when you consider buying a business, you're not buying, in most cases, of course you need your lawyer's advice on that, but in most cases you're not buying the corporation, you're doing an asset purchase. The reason for that is you don't want to put yourself in trouble and shoot yourself in the foot. That corporation that you're looking at in purchasing, it may have tax obligations, it may have a lawsuit that is pending or in the process. So basically the buyer would say, look, you keep the corporation, I'll buy the goodwill and the assets, and you establish your own corporation and you start from ground zero. Because God forbid, if you buy a corporation, a limited company, or a sole proprietorship that is going through challenges like the ones I mentioned, like taxes are being owed to the government or a lawsuit, when CRA comes to you, they don't care if you bought it and you didn't know about the past. The way they look at it is you have purchased this corporation, therefore now you're responsible for that corporation's problems, issues, whatever happened to be. So asset purchase, goodwill, that's what we look at. Okay. Now when it comes to the asset that you're purchasing, something that you got to really look into is if there are no monies being owed on those assets. If it is, they need to be settled down on or before closing. So basically the day that you get your keys in your hand and you're all ready and excited to start, you got to make sure that you've bought a clean business. Another very important factor that you got to take into consideration is when you're buying a business, you got to look at the lease, the existing lease, very carefully. You can't buy a business if there is like 1 year, 2 year left from the lease. You want to make sure that you have minimum 3 to 5 years on that lease, and with the option to renew. In some cases, they buy the business conditional upon being able to renew the lease with the landlord. In most cases, probably 95% of the time, in Canada, probably in US too, I mean, it's different than other countries in the world. Let's say in Middle East, when you buy a business, that usually comes with the property. Very seldom that happens here. So in most cases, when you buy in a business, it's usually on the lease premises, and you got to make sure that you have a good lease. You're going to make sure that there are no surprises there. You're not going to buy something and then a year later suddenly your rent increases by 20-30%. Now, another important thing to take into consideration when you buy in a business is you want to make sure that there are no first right of refusal in the original lease agreement. For those of you who don't know what that is, basically the landlord put an option in there before your time that it would give you the option to purchase, but purchase the building, purchase the property. But the problem with that is usually in a very short period of time, 24 hours, 48 hours. Okay, basically, let's say if the property is $1 million and landlord send you a registered mail and say, look, I've decided to sell the property, and legally speaking, I have to offer you to have the option to purchase the place, and you have 48 hours. Let's look at the best case scenario, a week, to come up with the money, and you only have, let's say, $250,000, and you got to buy or borrow $750,000 for a commercial property, and that may not be an easy task. And if it is possible, it's usually at a higher interest rate. Anyways, on that comment, I hope this was useful for those of you that looking at buying a business or selling your existing business. And if you have any questions or you need further information, please call me. My number is 289-234-8800. And you can always check my website at www.sayfi.com. That's SAYFFI. Alternatively, you can check my YouTube channel under Mehdi Saifi. And on that comment, remember, a mind at peace is a mind at work. Have an amazing day.